morning, everyone, and thank you for being here. Very exciting times to be living in. And we are going to try to make our panel engaging and hopefully thriving as well. What I'd like to do is first introduce the panelists, and then we'll get into the topics one at a time. On my left here is Dick Peach. He is Senior Vice President, Macroeconomic and Monetary Studies function of the Federal Reserve Bank of New York. And of interest to us today is that Dick spent quite a long period of his life studying the housing markets and housing finance. So should be able to get a good view on the recovery there and the implications for markets on that. To his left, David Malpass. David owns his own firm, Enzima Global, which is an economic research and consulting firm. And importantly to us, besides having been chief economist at Bear Stearns for a long period of time, in the mid-80s to the 90s, he spent 10 years down in Washington with the Reagan and the Bush administrations in a variety of positions that could help us get some insight as to what's happening in Washington nowadays. Steve Gallagher is the head of research at Societe Generale. His responsibilities cut across all the asset classes from economics to currencies, equities, bonds, rates, and the like, credit markets, etc. So we can get quite a good perspective on the markets across the world and across asset classes and what they mean to us. So with that, let me, three of them are economists, so what we had in the panel before was clearly a focus mainly on economics. There will be some overlap in obviously economic matters here, and we'll try it a bit to also focus on the impact on the financial markets and especially asset prices, what's embedded in them and what's not, what could be a surprise. But it's a little bit of a continuation of the panel before. So clearly there's no panel like this that cannot be introduced with what happened this week at the Fed and obviously the looming decisions that are coming up in the next few weeks with the debt limit and potential shutdown of the U.S. government. So if we can start with you, Steve, on that. And if you can tell us, what's your perspective on what's happening, and importantly, after that, what do you think is embedded in asset prices and what is not, or what could be shocks or surprises?
Okay, that's a big question. Glad to tackle it. You have three economists now and three economists before, and there's an old adage: you put 6 economists in a room and you got at least 20 opinions. So that's probably true in this case as well. So we have had both monetary policy and fiscal policy, hit the markets in a very short time frame. We had a surprise from the Federal Reserve and the fact that they failed to taper when it was widely expected they would begin to reduce the amount of purchases from the market of Treasury and mortgage-backed product. And more than that, I mean, we were only expecting maybe 10 billion of reduction when they're purchasing about 85 billion a month, so it was a very modest amount. But the fact that they can't get started and they're not communicating to us, or at least not well, or at least we're not understanding, what it is, what's the criteria for them to reduce and finally end this quantitative easing exercise that's been with us for several years. Fed Chairman Bernanke floated the idea as early as May that they would begin to reduce the amount of purchases from the market. The market at the time was not fully expecting it. They knew it has to, of course, they have to stop making these huge purchases at some time. But they began a debate of when they might start tapering. As the debate continued, the data and the economic data strengthened. There tended to be a reinforced idea in Wall Street that they would stop in September. And the normal path of the Fed sees the market getting it wrong or misstepping, they might nudge the guidance or nudge us in a different direction, and they kind of failed to do that, which really cemented and reinforced expectations for Wednesday, and then they sort of derailed us with not following through on a taper. And they gave us the idea that, employment is not yet sufficient, or the economy, or and particularly employment, is not yet sufficient. And that's long been a guidepost for them. The second criteria they threw at us was inflation. And they've given that to us before, so it's not suddenly new, but it seems to have more impetus or importance in this decision or more. And the third one was just the financial conditions tightening, which they told us a few weeks ago that tapering was not a tightening, but now all of a sudden tapering seems to be a tightening, and they didn't really get explicit on that, but we'll have to see. But when we talk about monetary conditions tightening, it's certainly not the equity market that's at all-time highs, and it's not the bond market where Verizon just issued $49 billion in debt for the largest debt issuance we've ever seen. It seems to be more in the mortgage market, with mortgage rates rising and the uncertainty that higher mortgage rates pose for the housing market. That seems to be the number one tightness in monetary conditions or financial conditions. The second is emerging, and you heard a lot of stories here, a lot of insights, very interesting ones in the earlier panel, is that the idea of tapering and the dramatic impact it had on Treasury yields, with the 10-year Treasury going from about 160, which is where it was about the time that Fed Chairman Bernanke first discussed tapering. It's jumped up to as high as 3%, and now it's about 275. But it's had a tremendous knock-on effect onto the emerging markets, and we saw a lot of emerging currencies suddenly plunge, and the equity markets there also make a deep pullback. They've since recovered. They actually recovered a lot more with the lack of tapering news. So we're digesting that, and then jumping to fiscal policy and the debt limit and the continuing resolution. I just want to make sure that everyone knows David Malpass has more vested interest maybe than I do. I'm more neutral on it, but here we go again on the debt limit and continuing resolution. The new fiscal year starts October 1. It's just days away. We don't have authority to spend from the different government agencies at that time, so we might have forced shutdowns. And the OMB, the Office of Management Budget, has already indicated we might be suffering forced shutdowns. Non-essential personnel, may not get paid, and they may not get any clarity on when they may be paid, because if they do, it's like an IOU, which is cheating the system. Typically, they get paid. We've been here before. We've been here before in terms of the threats so many times. It's just almost nauseating to go through it once again. And 3 months away from it, you always think you will get through it, and you have tremendous confidence. And it's a game of chicken. You never believe that they're going to go over the cliff in their cars as they race towards the edge. But as you get closer and closer, it gets quite rattling for the financial markets. And here we go again as we get to October 1. I think we'll get through it. We'll get a continuing resolution. Postponing these decisions only a little bit further, it's like kicking the can down the road. We hear that often. It's upsetting for the financial markets. It's not a disaster for the financial markets. It's not a catastrophe, even though we're going to be hearing those kind of headlines. The last time we saw the government shut down was 1996. The economy in that quarter grew at 2.5%. I looked it up again this morning. They always revise these data, so I had to check it out once again. It was a weaker quarter than the quarters that surrounded it, and I think that's important to recognize. So it did, it's hard to see what, just look at the raw number, it's hard to see what impact it might have had on the economy. It has, to me, the impact not on so much spending cuts, but how much uncertainty it imposes, and it makes people stop making important decisions, and that slows things down a little bit. On the equity market, we saw a momentary pullback in the equity market. It was a modest, in hindsight, the days of, it was more stronger, but that was a modest pullback in days when we were in an exceptional equity market rally. I mean, that was going into the bubble days for the irrational exuberance. So the fact that we had a pullback was noteworthy. Lastly, I just want to give you the market color around all this. The Treasury market is where we saw the biggest change with the government shutdown. If the U.S. government were judged like a corporation or a developing economy, the recklessness we see out of Washington and Congress would be a disaster, in which sends yields skyrocketing. What we see in this country in 1996 and what we saw in 2011 when we saw the downgrade of the government debt from AAA to less, is that treasuries in fact rally, and they rally tremendously. We saw yields decline in early 1996 on the scare and fear that led to a safe haven rally that drove yields down significantly. We saw it again in 2011. So my moral on that is that while we talk about dysfunction in Washington, we talk about the credibility and the promises of Washington, the reality is we honestly believe that it will be temporary, that yes, they'll lose their heads, they'll shut down governments, they've done it before, but it has proven temporary. We strongly believe in the market, it is temporary. That's the only way we continue to buy the Treasury debt the way we always have. It's so much different than a company or say, developing economy that wouldn't enjoy the status of credibility as a U.S. Treasury.
And Dick, seems like a lot of the decision-making process here is centered on the housing markets and potential impact of monetary policy on the housing market, in addition to obviously employment. What's your view of what is truly happening there, and the impact on that on the monetary policy?
Sure. If you look at a consensus forecast for the United States, I listened to the earlier panel. They were generally upbeat, thinking about that growth might go up to around 3%. In 2014, it's been running around 2, maybe just a little over 2 for the last 16 quarters. You take that projection of growth going to 3% and you look at some of the individual components of it. A key component is that residential investment will continue to provide a significant amount of growth contribution. During the recession, residential investment was subtracting about a full percentage point from GDP growth. And we've moved to a situation now where I think over the last year it's contributed maybe 0.4 of a percentage point to growth. Very big swing, 1.5 percentage points. So you can see how important the housing sector is for getting us out of recession and then getting into growth. But again, we need to keep that 0.4 growth contribution or even more if we are going to realize this 3% growth for the economy and everything that goes with it, very importantly, a stronger labor market and stronger employment growth. We had a very nice improvement taking place in the housing sector, but then activity, whether you're looking at starts or new home sales, that sort of thing, kind of peaked around March of this year. A lot of people focus on the rise of rates that happened, say, from March or early May onward, but we even had a little bit of a interest rate shock to the housing sector from late 2012 into early 2013. And the combination of that earlier rate increase and the more recent rate increase really has stalled out the housing recovery. Housing, if you look at single-family housing starts, they're basically pretty flat. If you look at the Mortgage Bankers Association has a weekly index of applications for mortgages to purchase homes. That peaked in, let's say, early May, early to mid-May, and has fallen 15, 16%, has stabilized over the past couple of weeks. But the problem is that if all we get is a stabilization of the housing market, again, we're not going to get that 3% growth that everyone would really like to get in 2014. And so I think Steve is right on. What's been going on in the housing market was kind of front and center. I don't want to give anyone the impression that I was at the meeting or anything like that, but I feel that it was a very important part of the considerations that were taking place. And I just want to add that I agree with what the earlier panel said, that the underlying fundamentals of the housing market have improved a great deal. In fact, I would go so far as to argue that what's going on in the United States now is that a shortage of housing is beginning to emerge. It's definitely true in Manhattan, but it's becoming more and more true around housing markets around the country is that good properties are in short supply. There's not a whole lot of new homes to buy because single-family housing starts are only like 600,000 at an annual rate. There's not a lot of existing homes on the market. The ones that are in very good shape are getting snapped up very quickly. And there's a feeling within the real estate community that housing market activity could be even stronger than the official statistics indicate because of a practice that has reemerged called a pocket listing. And this is a practice that's quite common in New York City, but it has spread to other parts of the country. And that is, you and I are neighbors. I'm a real estate agent. You want to sell your house. And we meet in the backyard, and you say you're thinking about selling, and I say, well, look, I'll take your listing, all right? I'm not going to put it on the multiple listing service. I'm going to put it in my back pocket. And I happen to know lots and lots of people who are interested in buying homes. And if you agree with me on this, we can make a deal on the commission. But if you put it on the multiple listing service, there's nothing I can do about the commission, And this practice apparently is cropping up around the country, and the National Association of Realtors data on existing home sales is only based upon multiple listing service activity. If you look at home prices, they're rising fairly rapidly now, 12, 13% on a year-over-year basis, and even more recently, we've begun to see the two rent measures of the Consumer Price Index. The rent that the tenants pay to landlords, but also this opportunity cost of owner's equivalent rent. Both of them have begun to move higher again on a year-over-year basis. So there's a lot of upside potential, I think, for the housing market, but we need financial conditions to be supportive.
And David, when you look at what Steve said and Dick complimented in terms of the fundamental of housing and potentially the decisions by the Fed, and obviously you're a frequent visitor to Washington and many of the congressional hearings and the like. What is your sense of, one, what is truly happening, and then secondly, is the market fully discounting all of this, or you think that, and therefore saying we've seen this before, who cares? We gotta wait till the last minute and see what happens, or is there an alternative to that?
Yeah, I guess my general view, very broad brush, is that markets are kind of properly priced now. There's not glaring anomalies, and that's because, as Steve said rightly, the market's been through the fiscal turmoil many times in the past, and so I think that the markets won't be the focus of the current turmoil. It's more the politics in Washington. So the issue of, do you want to shut down the government, and what would the polls show that the public feels about that? To me, that will be a bigger issue than what the markets might do, and the reason for that is the market's kind of prepared for however that comes out. So that'll take me to a bigger point that structural reforms around the world, if we talk about emerging markets, I'll come to that, but it's very apparent in Washington that a key issue for markets long term is what structural reforms are actually put in place. So I have a vested interest, as Steve said. I've written a lot of my columns in Forbes and in the Wall Street Journal about the need for Washington to use the opportunities that it has to try to find a system of restraint on how the government grows. Some of my columns have talked about the evolution of how did we get to a point where the government really has been growing without any boundaries. There's no limit on the amount of debt the market will be willing to buy from the U.S. government. Japan has shown us countries can go up to 250% debt to GDP ratios, so that the markets don't really provide a restraint on the borrowing of the government. In Europe, they've tried to do the Maastricht Treaty concept, but then they didn't do it very well. Remember, Germany kind of opted out of that first, and then France did, and then very quickly Greece said, well, if those guys can borrow all they want, we'll go ahead and out-borrow them, which is, a way that they moved forward. So as I look at what Washington's doing right now in both the Fed and the fiscal situation, it's a matter of how do you get them to stop expanding relative to the private sector? Because when they do that, the country gets less jobs. So let's be very specific about it. What the Fed is doing is, I think, very harmful to economic growth, and that shows up in the data that we've had from 2009 to 2012. Why did we grow so slowly? Well, what the Fed does is borrows from the private sector and guides the capital into the government and big corporations. So it's very much part of this process of the rich getting richer and leaving small businesses underfunded and new businesses critically. One of the shortages the U.S. economy has had over these recent years is not enough new businesses being formed. And part of that is just the tight credit conditions that face the little guy relative to the big guy. So what we see in financial markets is more and more the big financial firms setting up things that look like banks. They get almost free money from the Fed, and then they trickle it down to as they can develop a chain of distribution, which gives us some growth, as we've heard. So I want to take a little issue with the previous panel, the idea that it would be okay if Washington just did nothing now, and then we move forward into next year. That was one of the themes of the previous, that if we could just get over this debt limit hurdle, then things would be okay. And the problem with that is the definition of okay. So the normal that we have right now is money flowing to rich people in giant proportions. We see it in the real income of the household sector has been going down and down, while the stock market is going up and up. And so I think it's unsatisfactory to leave things the way they are. And specifically, I've proposed and wanted them to use either the debt limit or the continuing resolution or the Federal Reserve's downsizing process to try to break out of the new norm. And specifically, that means a menu of options where they actually have a debate in Washington about ways to restrain the size of Washington. The income data that came out this week showed that Washington is having the biggest boom. It's a gilded age for Washington. The income's going up at just incredible pace in Washington, and the rest of the country being restrained. So that's the issue I think that's at stake in the debt limit right now. And I testified on Wednesday to the Joint Economic Committee on ways that they could confront this, and specifically, I think they need a menu, and included on that menu is one way to factor in the debt that the Fed is, the Fed is creating this big overhang of very short-term debt, very risky debt that the Fed is using in order to buy bonds. So therefore, that could be part of this discussion. How do you restrain the Fed? I see a lot of military in the audience, so one of the practical applications of this is we've got to find a way with the sequester to allow some of the spending within the government to be reallocated to better programs and some of the less successful programs downsized. They have no process right now to reallocate spending to the things that work. So that, to me, means we can't just go through the fall and try to get over this hump and get on to next year. We ought to use the opportunity right now to get some change.
The second, and hard to say which one is more important, but the second major policy issue for the Fed and obviously for fiscal policy in the U.S. is the employment picture. And that has a significant implication on consumer demand, and therefore eventually equity prices and debt prices in the market. So you and the Fed have done some work on employment and what's happening there. where are the shortages, where are the abundance, and what's happening to the U.S. labor markets?
Well, I've done some work on labor markets, but we have an army of economists within the Federal Reserve who are leaving no stone unturned in looking at what's going on in labor market conditions. Let me just share with you some of the longer term things that we've noticed. Some of our economists have taken the workforce of the United States and divided it up into 4 groups that are sort of analogous. They're sort of income and skill groups, if you will, and they're roughly of equal size. And and this is not a new development. You go back for a decade, and the employment of the highest skill group has been rising quite nicely. Actually continued to rise even during the Great Recession. Employment of the lowest skill group has been rising, and all it did was kind of level off a little bit during the Great Recession, and now has begun to increase again. Employment in the middle 2 groups is falling like a rock, and this affects our political dynamics in the country. It affects the potential rate of growth of consumer spending. And what it's due to is it's a chicken and an egg kind of thing. You talk to some employers and they say, we have dozens of openings of jobs for people who would know how to run a machine. A modern machine today is controlled by a computer. So a machinist today is actually a fairly high-skilled job. You need to know how to program a computer and maintain a computer, but the computer does all the work. Well, they're having difficulty finding people who can do that kind of stuff. So we do have a longer-term employment issues, education issues that might make our future a little less rosy than the previous panel would suggest. But then on a very short-term nature, which may also have some bearing on the decision that was made, there's so many labor market indicators that you could spend your whole day looking at them. I try to, since I have other things to do, I look at one, and that's the rate of growth of hours worked in the non-farm business sector. And it was over 3% in the first quarter of this year, just a little over 2% in the second quarter of this year, and is likely to be only around 1% in the third quarter of this year. So there's some signs that we may be emerging from this soft patch. The ISM indices were mentioned, but at least for the here and now, it looked like things were actually slowing relative over the course of the year. Employment, and incomes were slowing, not accelerating.
Steve, would you care to comment on unemployment and what you see?
Yes. I mean, unemployment, I'd be very interested in seeing the skill level. It's not readily available, and it is disturbing. And we all know that to some extent. We have shortages for skills, and we try to bring in specialized labor from abroad. We try to bring them from engineering schools. They come to our U.S. schools for their education. They used to stay here, and now they're going back home where there's plenty of opportunities for them. And so we used to be the beneficiaries of the brain drain, and now we're educating these people, and they're leaving us. And it's a shame. We really should be looking at our immigration policies more and opening up to the skills sets that we need. Or worse, try to promote some of our U.S. citizens to take these higher skilled educational routes so that they're better prepared for the economy of today and tomorrow. But anyway, that's a longer term issue. Shorter term, I see all those participation rates and we look for, it's really down, and we're down to the lowest in several decades, and it seems like a more prominent feature from the Fed, in which they're looking more at participation rates than the unemployment rate, and they're discounting what's been the traditional barometer for Fed policy on this participation rate. there's a lot of things going on with our economy that we don't fully understand, and that's why we have huge teams at the Fed studying it. Two items that are interesting that are going on is are young people not working? Someone said on the earlier panel that doesn't really matter. Well, it does in terms of gaining those skills. It's a huge thing. I mean, it doesn't matter if you're taking a McDonald's job or you're working as a programmer for some video toy. I mean, giving a wide range. You're learning discipline. You're learning a lot of key aspects of holding a job, maintaining a job. That, as an employer, I mean, I hire people. I hold in high esteem. Young people today don't work. I mean, the job opportunities aren't there. Clearly, yes. I mean, I agree, I see that, but they're not going to take a McDonald's job anymore. They're not going to take a low-paying, low-skilled type jobs, even though I think it does add to their skill level. It's very different than in the past. What are they going to do? They're going to go get a student loan and go to school, and that's a separate problem. But I wonder if they're being trained in the right areas. I think maybe that's something we need to look at. And then the older population, somebody talked about them, the population of older people working is soaring. The sort of yes and no. What you're having is a baby boom that's, that we look at 55 and older, and this is an area of some of the strongest growth within the labor force given the baby boom. And early in this phase, the 55 to 70, they're working probably more than they ever have. I mean, I think that's true. It's because they didn't save enough. That's sad. But it's also because they're healthier with longer life expectancies, which are tremendous advantages to this economy, and they want to work longer. I mean, that's a great thing. I see more good than bad in that dynamic. So I think to me, that's a very, getting the right skill sets is a big problem that Washington should be addressing and focusing on more. Labor force dynamics are very complicated, but there's a lot of good in there as well. So I'll end on that more positive tone.
Can I add a short point? I think we shouldn't be fatalistic. There are ways, the U.S. economy is this great economy, and all we need to help on these concerns in the employment area is more hiring, mostly by small and new businesses, the creation of new kinds of jobs. And that can happen pretty quickly. So if we think about the economy, all that's needed is what would help us get to the point by next year where the small businesses around the country, which is still the lifeblood of job growth, would add an extra worker. And, one of the things I've written a lot, the Fed's got to stop buying bonds. It's very harmful to smaller businesses to have them putting the extra money into big businesses. So that would be one, and I wanted them to taper because that would get us started on that. And then in Washington, have some lowering of the temperature would help, that kind of thing.
Well, the markets are global, and be a good time to focus a bit on that. So David, you've done some work in some of the bigger economies and some of the emerging economies of the world. What is your view of some of the economic transformation that is going on in Japan, some of the rebalancing in China, obviously the solving of the fiscal problems in Europe, and the like. So to give us a sense of what you see, as sort of a bird's view of what you see in a lot of these places, and what is discounted and what is not, in the equity markets or the debt markets.
Yeah, so on the market side, I guess I was pleased kind of, about what happened over the last 6 months. As the Fed began speaking about tapering, then the bond market yields went up, as Steve mentioned, and it really had a harsh impact outside the U.S. And so we saw sell-offs in Indonesia, in India, in Brazil, and in South Africa, elsewhere. And then things stabilized without any, and so that brings me to a point. I think the world kind of financial system is in a somewhat stable position. Now, that doesn't mean European banks are all healthy, but in the real macro sense of how things are working, there's a stability that, and if you, so let's go back a little bit. In the 1970s, the world moved off the gold standard. You had very high inflation, and it was a very complicated environment. Oil prices went up a lot, and that changed the way the world worked. In the 80s and into the 90s, we had what the U.S. calls the Great Moderation, or where things settled down and interest rates came down. But from the standpoint of emerging markets, it created a very tough environment because the dollar was strengthening, and they borrowed a lot of money in dollar terms. So you saw the Mexico crisis, then the Asia crisis, Brazil and Argentina and Russia all sank into really bad crises, things like we haven't seen really since the Great Depression. So deep crises that shook their structure and often toppled governments and so on. And then we switched rather suddenly in the 2000s to a weak dollar policy that actually worked pretty well for emerging markets. So you went from a harsh environment to an overheated environment. So we saw booms going on in China, in Brazil, down the line, that meant they outperformed the U.S. So equity investors were better off in almost anywhere in the world other than the U.S. in the 2000s as that process unfolded. Well, so now there's a little bit of a normalization that for emerging markets. There's this very healthy change that's occurred over the last 30 years where they used to borrow in dollar terms, and now they borrow in their own local currencies. So in Brazil, there's a 20-year bond that never used to exist. And around the world, in Turkey, there's a long maturity bond and financing available. And that means that when there is kind of a shock, like we saw this spring, they don't react as there's not quite as, we used to say if the U.S. gets a cold, the foreign countries get pneumonia. And that, maybe we're a little bit over that. So my view is pretty constructive. As we look at China, they have new leadership that seems to be making good decisions. China, remember, has invested a lot in having a stable currency and having real value for money. And so investment continues high in China. And their per capita income has been rising very rapidly, which is good for the world. They become an interested player in all of the world dynamics. So I like what's going on there. In Japan, they have a new prime minister, Abe, who has said he's going to do structural reforms. So again, my theme worldwide is we want to see governments make changes that allow more jobs. So let's just say that. And so in Japan, people know what's needed. They just won't do it. And one is in the agriculture sector. They have a very protected agriculture sector. The U.S. has a protected one. Japan's is much more protected. And so it costs them jobs. They can't seem to budge on that. In the retail sector, they have work laws that make it very hard for people to create efficiencies in that sector. Abe has kind of hinted that he's going to do something in these areas, but it's not clear that they're going to get on with it. So I think in the case of Japan and in many of these countries, the U.S. included, we ought to invest based on change on the margin. So if you see the leaders saying, look, we used to be doing this and we're going to make these constructive changes, that's worth a lot. That would certainly apply in Europe, where in the periphery, they just haven't done structural reform. So if you look at Portugal or at Spain or at Italy or Greece, they've fallen into deep recession without really making any changes to try to stop that. They're getting money from Germany is the basic strategy for the weaker European countries. Well, that's not much of a strategy. And so after Merkel's, the German election is Sunday. It's very important how it comes out. And we may begin to see whether there will be some kind of structural changes in Europe to allow them to become competitive. So that's my thought. The word to the wise is structural reforms are really important, and markets will value them a lot if they occur. Well, you're from Mexico, so maybe you could, so Mexico is going through dramatic change, and it might work. And so my view as an investor is the markets tend to really reward the changes that go on. For 30 years, we've wanted Mexico to allow ownership in its energy complex. And they've had government ownership. And while other countries around the world have changed, Brazil, India, and so on, Mexico didn't. And so now they have an opportunity to change that. And if they did it, you know, it's a huge, Mexico's per capita income could go up as fast as China's if they made structural reforms.
Can I be a naysayer for a moment? I'm a totally agreement on Mexico, by the way, so I think that some of the reforms are positive. We did the whole world. China is one thing that I think we need to highlight a major challenge. And I think they are making all the right reforms, but the financial situation in China is a serious issue for the global economy. The debt load and the debt bubble that they've had in China that's being channeled to shadow banks and at the state and local level, what would be our state and local level, is huge. They have a 200% debt to GDP, which has normally been associated with major crises. Now, what China does enjoy in this is what sets them somewhat apart and what's prevented a crisis so far is that everyone perceives the Chinese debt as being fully backed at some point by the Chinese central government. And that may be true. It's not being held by the Chinese central government. And transitioning from there to the Chinese central government could be a major challenge for the overall economy. Those that hold the debt, those are paying back the debt, the defaults are going to soar. They are rising with the soft economy already. And the transfer of the liability to the central government doesn't happen overnight, and it doesn't happen very smoothly. China is different than Europe and sort of this doom loop, what we call the doom loop, that the Chinese government, the credibility and creditworthiness is so strong that for the moment it's backing all this debt, even though it's not in the central government's hands. And I'll give you just the Europe. I'm from a European bank that David so nicely alluded to there. But you know, the problem in Europe is that they are suffering a doom loop, where we say that the government, the financing and the creditworthiness of the government are weak, or are weaker than they should be to back a large financial institution. In the U.S., the Treasury is so strong it can back even a weak, large financial institution as they did during the crisis. So there is some positives on that, but it's going to be a very serious challenge in China for the next few years, even though I think they're doing as good as you might expect.